Welcome to Tokenized. My name is Simon Taylor. I am your host of the Tokenized podcast, author of FinTech Brain Food, and head of strategy at Sardine. And joining me is my friend Cuy Sheffield, head of crypto at Visa. What up, Cuy? How are you?
I am fantastic. I'm excited for today. Yeah, we've got Kyle Samani, one of the best investors in the space, one of the deepest first principle thinkers. We're going to unpack a lot of things with him, so let's get into it.
All right, Kyle, thank you for being with us, my friend. Let's start with the origin story. How does Multicoin come about? How do you get into this space? And how do we get to where we are today?
Hey, Simon, thanks for having me on the show. And Kai, good to see you again. Pleasure to be here. How did I get in the space? Obviously, I heard of Bitcoin in 2012, 13, whatever. Did not find it interesting in the slightest. Still don't find it interesting in the slightest 13 years later. I got into crypto because of Ethereum in 2016. I had exited my last startup, which was in the healthcare space, had nothing to do with crypto or fintech. I had studied finance in college, and I was programming when I was a kid. And I discovered this thing called Ethereum in March of 2016. And I realized fairly quickly that I was like, oh, I can program this Ethereum thing to do anything with value transfer or value movement. We now kind of call that term today, or that concept, permissionless finance. The term permissionless finance did not really exist in 2016, but as I understood what I could do with Ethereum, I understood the seed of that kind of core idea, and it struck me as quite powerful. And so that's kind of how I fell into crypto, was via Ethereum. Over the course of 16, dove deep in the history of the space, obviously go in the history of Bitcoin, cryptography, distributed systems, consensus algorithm, all these kind of mechanical things that make these systems work. And by early 2017, I realized, hey, I'm not thinking about anything else other than crypto. And so I made the decision to launch Multicoin in May of 2017. We launched our hedge fund on October 1st of 2017. Today, we're one of the oldest and largest crypto-focused investment firms in the world, with about 3 to 4 billion in assets, depending on the day.
I think I remember, I'm pretty sure we met at a Chipotle in San Francisco in like 2018. And you were one of the first crypto investors I talked to that was like bearish on Bitcoin. You're like, Bitcoin's boring. I don't care about Bitcoin. And so I think you've got a really good way of describing kind of what is a blockchain, just from first principles. For someone who hasn't been in the space, how do you think about the purpose of a blockchain and what it actually does?
Blockchains are asset ledgers, and they are not more than that. I use the term asset ledger intentionally to piss off my crypto brethren, because it's a boring accounting term. And all this thing does is track at any moment in time. The current state of the blockchain tells you who owns what assets. Those assets could be anything. It could be Bitcoin, could be dollars, could be commodities, it could be meme coins, it could be a debt obligation, it could be a futures position, it could be a collateral you've deposited into a borrow-lend protocol. But fundamentally, on your balance sheet, you've got assets, you've got liabilities, and blockchains track those assets. That is what they do. If you boil it down even further, obviously I can send you $5 and that's a payment. And what is a trade? A trade is just two atomic payments. I send you $5, you send me one Apple share. And that core primitive effectively captures everything in payments and finance.
Pretty primitive when you talk about it. There's some other stuff going on in the logic layer, but that's happening in the software layer. Talk to me about, you'd been involved in Ethereum, you'd seen that space, you'd programmed in it, you'd launched the fund, but then Solana comes along. So how does that come about? And what is your thesis when you first saw Solana?
Yeah, so got into Ethereum March 2016, and obviously through 2017, ICOs are launching left and right, and the gas fees are starting to spike, and the network's becoming unusable. And all of this was known ahead of time. I mean, if you go look at the even public discourse, documents, blogs, videos from the core Ethereum people before the network launched, they all were like, we have to solve scaling, otherwise this is going to happen. So all of the scaling problems were forecastable and understood. 2 years later, so it's they launched blockchain July 30th, 2015, plus or minus a day or two. And by middle of 2017, it's been 2 years, absolutely not even an attempt to solve the problem. And that's why gas fees start spiking left and right. I start getting pretty frustrated. I'm like, guys, like, what are you doing? Like, we got to fix this thing. It is fast forward November 2017. It is Ethereum's annual developer conference, DevCon 3. It's in Cancun, Mexico. Multicoin is 5 or 6 weeks old at this moment in time. Like, we had just launched our hedge fund a few weeks prior. And the story of 2017 in all of tech was Ethereum. Ethereum was up 100x year to date. ETH was the fastest asset in human history to $100 billion in market cap. And obviously ICOs left and right, like it was bananas. And you have this problem, and you've had this problem forever. And it's your annual developer conference. Obviously, this is the venue at which you here being Vitalik and the core Ethereum Foundation leadership will unveil the like grand plan to like solve the scaling problem. Literally nothing. I mean, they had some like workshops on like different ways we can scale, but like there was no definitive concrete plan. Hey guys, hair on fire problem. We know we need to solve this now. Like this shit's going to be solved in 2 months. That's what I was expecting. And that did not exist. And I remember I left DevCon 3 and I was like, how can you not understand where you are? And I was just so perplexed. And that was the moment that I completely wrote off Vitalik. I completely wrote off the Ethereum Foundation because I was like, culturally, these people do not live on the planet Earth. There is no other organization in human history that could have this degree of success and be this clueless to like the world around them and the expectations of the world around them. And so at that moment, I began looking for alternatives to Ethereum because I was like, this is atrocious. We ended up putting on a position in our hedge fund in December of 2017, so a few weeks later, in an asset called EOS. EOS famously flopped, and we lost a lot of money and had a big egg on our face. EOS, I would say, is spiritually similar to Solana, and that they're like, it's a general ideology was like bigger machines, maximize resource usage, and like make it go faster. The EOS team was way overcapitalized, had a bunch of other problems. Mechanically, there were a bunch of actually bad design decisions in the tech. Ultimately, all of those things caused it to flop, and we had a nice big egg on our face. We did not put all of our eggs in one basket, meaning EOS. We were obviously looking around at that time. Every distributed systems engineer in Silicon Valley was looking at Ethereum at $100 billion in market cap, saying, this is architecturally dumb. I can do better. And so tons of people go out to raise money at the Q4 2017 and all through 2018. I mean, it must have been at least 20 or 30 teams that raised venture money. Algorand, Near, Definity, Thunder, Solana, there was a whole bunch of them. And we invested in about 3 or 4 of them, but Solana was by far the biggest we put on and the one that we like cultivated the relationship with the team and got involved. And what stood out to us about Solana was 2 things. One, Anatoly, the founder and chief architect, he is the only L1 founder who had a product focus. The title slide for the pitch deck for Solana seed round said NASDAQ at blockchain speed. And Anatoly was very clear from day one, I want to put a central limit order book on a distributed global blockchain. And all of the other L1 founders were like, we're going to build a blockchain that scales and we're going to make Web3 big. And like, but like there was no product focus. It was just like a generic tech statement about like some notion of performance, but no product vision. And that stood out to us. And the second thing that really stood out to us was Anatoly was very clear from day one that he refused to solve any unsolved computer science problems. Earlier in his career, he had attempted to solve some unsolved computer science problem and it fallen on his face. And he spent like 2 years working on something and it went nowhere. And he's like, look, we know there are tons of tricks in distributed systems that you can use. Anatoly was a high performance engineer at Qualcomm and at Dropbox prior to founding Solana. And he's like, I'm going to take every single trick I learned in operating systems and virtual machines and networking and distributed systems. And we're just going to apply all of the known basically optimizations to a provisionless database. And we're going to call that thing Solana. And all of the other founders, again, I had the fortune of talking to every single one of them, were like, we're going to solve all these new problems. And I was like, this guy sounds funny. And, the product focus and the explicit refusal to take on science risk really stood out to us. Now, there was a tremendous amount of execution risk. They almost ran out of money several times. They, quite frankly, took on more than they could chew. Like building a VM, a networking protocol, consensus, all of these things was like, it's just an extreme amount of just difficulty, but all known problems. And so we got a lot of luck involved, but those are really what stood out to us about Solana in the early days.
When you think about the vision, the NASDAQ, on a blockchain, and kind of working backwards from how to get there, like, has the path surprised you at all? Like, did you expect, like, when you were making the early investment there, that meme coins would be an area of product market fit, that would drive adoption of this infrastructure? Like, what was kind of your expectation then in terms of how assets would be traded on this new asset ledger that could move at the speed of the light versus what you've seen since then? And how do you think about the path towards that vision today?
Yeah, I mean, look, what tokens were people launching in 2017, and they were ICO white papers, most of which were garbage. The other difference between an ICO white paper from 2017 and a meme coin is the white paper. And I was able to fool myself to think that like the white paper mattered for the bottom 99% of endeavors. Now, look, for the top 1% of endeavors, the white paper or like the deck or the business plan does in fact matter. But for the bottom 99%, it empirically doesn't. But look, it's fun. People want to try stuff. Like, let them go try stuff. I'm all for like capitalism. Go have fun. You want some investor protections in place, but like generally pro capital formation. My expectation was that the types of assets that would launch on Solana would be ICO white papers, because that is what I could see at the time. Did not think NFTs were going to be a thing. I understood the concept of again, the term DeFi would become coined in about October, November of 2018. But like why I got into crypto and into Ethereum was like I understood permissionless finance or DeFi, although the terms didn't exist. What I could not forecast was, we're going to have these independent modular protocols, ability to do bilateral swaps, the ability to do borrow lend, the ability to do perpetual protocol contracts, the ability to do CDSs, options, as modular protocols, all of which you could then use the collateral in each of those things and plug them into the others. That I couldn't make that jump in 2016, but I understood that conceptually you could build all of these things. And so I was excited for seeing financial primitives. And in fact, like the first position we put on in our hedge fund when we launched it on October 1st of 2017 was a protocol called 0x, which is mostly forgotten these days. But it was at the time the leading way to trade assets on the Ethereum blockchain, because that was the only chain that was around at the time. So we were pretty focused on finance. We could not have envisioned AMMs. We could not have envisioned liquidity pools. So the mechanical ways in which the protocols played out, like we had not the slightest clue. But we expected people to try and raise money to go try and do novel things, which obviously has turned out to be correct, but it's been funnier and wonkier than we expected.
It certainly has. Speaking of funny and wonky as well, like there's the term now DePIN or decentralized physical infrastructure. You guys were quite early in some of the projects there, like Helium and others. What was it from a thesis standpoint that you saw about those projects, and how do you describe them to people today? And it might be worth describing like Hivemapper and Helium to the uninitiated.
Yeah, so DePIN stands for Decentralized Physical Infrastructure Networks. And we were definitely the first VC to like lean into that hard and kind of help make it a thing. Full credit to Amir, the founder of Helium. This is his baby, his brainchild, but we were the primary capital backer of that in the earliest days. So what is DePIN? Or actually, what is Helium? Helium is a new business model for deploying and managing wireless networks. The idea of Helium is, hey, if there's somewhere, whether it's your house or your small business or wherever, and the cell coverage sucks, you can buy a hotspot, yay big, and you can put it in your window, plug it into electricity, plug it into Ethernet, and it's got an antenna, and it'll make radio waves. And any device walking around nearby that wants to access those radio waves can pay you as the hotspot owner per byte of data that they access. Very straightforward concept, very intuitive, and it's like, in the very purest sense, capitalism, like pure bottoms-up, laissez-faire capitalism applied to the problem of put radio waves everywhere. You don't need to depend on the Verizon gods or the AT&T gods to like decide, is your house worth like covering? It's like, no, well, if I want coverage in my house, then like I'll put up the hotspot. And if my neighbors want to pay me, like my neighbors will pay me too. Great. It's like truly one of the most capitalistic endeavors you can imagine at global scale. And so that's the vision for Helium. And obviously you remove a tremendous amount of physical cost. Land cost goes to zero. Labor cost goes to zero. Bandwidth cost goes to zero because you're piggybacking off the consumer's home ISP connection. And so you're actually physically removing the three largest line items of cost in the deployment of the network itself. And so Amir, when he pitched us, he's like, look, I can do this cheaper because like he just had a line item, in the deck of like, here's the cost that it takes Verizon to put up a tower, and here's the cost it takes for me to put up a tower, and it's like very clearly like 97% cheaper, just like not even without, you don't even have to think, it's just obvious that's the case. And then the other part of DePIN that is actually much more subtle and actually have more importance is the risk component, which is as follows. If you are building a telecom network, there's a minimum amount of scale necessary to make the network useful. If you have a telecom network with one hotspot or one tower, the value of that network is $0 because no one is going to bother to like integrate with your network that has one hotspot. Maybe the minimum threshold before anyone will bother to integrate with your network, maybe it's 20,000 nodes, maybe it's 50,000 nodes, maybe it's 433,000 nodes. I don't know. No one knows what that number is precisely ahead of time. And so the beauty of the DePIN model is that you can actually dynamically allocate risk to the network participants. The first guy who buys a hotspot is taking more financial risk, meaning like that $300 hotspot that he buys, the probability that it ends up producing $0 of revenue is quite high because like, who knows if the network's going to get big enough, to be useful. Whereas the guy buying the 48,000th hotspot clearly is taking on a lot less risk than guy number one. And guy number 333,000 is taking on way less risk than guy at 48,000. And so the beauty of this model is you can design the token. So the early hotspot deployers, obviously on day one, there's no demand on the network at all. And so the way you incentivize the people to deploy the hotspots is by minting tokens, in this case, HNT for the Helium network. And you give those tokens out to the early people who do this, for the early believers. And obviously the earliest hotspot deployers should get more tokens than the later hotspot deployers because they took more risk. And it's a beautiful risk allocation mechanism. Whether you're an idiot, whether you just believe in IoT or in decentralized networks, whether you hate Verizon, or whether you just do the EV math and you just think it's like underpriced and you should go for it. It doesn't matter what your financial calculus is as an individual. You can say, I am going to buy into this thing. I'm going to try and be early. And if it works, I'm going to, reap the profits. And that risk component for permissionless global capital formation did not exist prior to Helium, full stop. Helium is the pioneer in this front. It's still like very underappreciated. And what they did was like pretty incredible. And that model that Helium pioneered is now being replicated for all kinds of different verticals. The next vertical that I'd say is at the second largest scale is what's called HiveMapper. Like we were fortunate to be the seed investors in HiveMapper. And HiveMapper is put a dash cam in your car, and when you drive around, the dash cam takes photos and videos and uploads them to build a map. Obviously, Uber drivers and Lyft drivers and FedEx drivers should clearly have this in their car, like given how much they drive. The idea that Google has a $250,000 car that they pay people to drive around is obviously stupid. And like, again, when you think about it, it's just like, no questions asked, this is the correct way to solve the problem. It's 99% cheaper, obviously. And HiveMapper is about 2 years old now and has mapped over a third of the roads in the world. There's about 64 million road kilometers on the planet. About 20 million road kilometers have been mapped. And obviously in major metros, whether you're in Austin or LA, or for that matter in Seoul, Korea, or in London or in Paris, even like cities like Cannes, France, the refresh rate that the HiveMapper network has is 100x higher than Google. And yeah, like some customers don't care about that, but if you're FedEx, you care about that. If you are Uber or Lyft, you definitely care about that. If you are Redfin or Zillow, you want fresh maps of the street. There's tons of people who want fresh map data. and Hive Mapper is a 100x improvement over Google in a lot of cities. And so this model of DePIN is now being applied to energy markets, drone markets, GPUs for AI inference. There's all kinds of different ways you can apply this DePIN model.
Super interesting. I wanted to switch gears and talk about payments and stablecoins. And so, in the context of Solana, how do you look at payments, as a use case, and kind of what are you seeing today around stablecoin use cases and ways that companies are looking to leverage Solana as a payments rail?
Yeah, so it's hard to answer this definitively with data. Like, there's a lot of data out there, but the data is hard to parse. The headline number that matters is number of stablecoins issued. Solana today has roughly 10 billion in stablecoins. I think they just crossed 10 billion like a week ago. I think they're at 11 or 12 billion right now. And the question is, well, what are people doing with those stablecoins? So we know how many stablecoins are there. That's transparent. That's easy. Question is, what are they doing with them? A lot of those stablecoins are being held by crypto traders for sure. And then a lot of those stablecoins are being held by people who are choosing to escape their fiat currencies. I don't think there's any Americans who are like, oh, I hate my Bank of America account, but I really like USDC on the blockchain. Like that person doesn't really exist. But there are a ton of people who live outside the United States, whether they're in Mexico, whether they're in South America, India, China, Southeast Asia, who absolutely want dollars and they do not want local fiat currencies. And they are definitely holding their stable coins on blockchains. There's roughly 150 to 200 billion in total stablecoins outstanding today across all chains. And I think, I can't prove this, but my suspicion is more than half of that is people explicitly escaping local fiat currencies. The challenge, of course, is those people are not raising their hands and writing Twitter blogs and news articles saying like, look, guys, I successfully escaped my local government. It's very difficult to reason about it. You can make some probabilistic assessments by looking at like the type of payment flows to and from those addresses. I'm surprised actually this isn't more out there, but you could use some ML to probably figure this out. But that my intuition is that more than 50% is that. Once people have stable coins, like there's two things they can do with them. One is they can hold them as savings, and two is they can spend them. And so, I think we're just now getting to the point where, at least in emerging markets, there's a lot of people who are starting to pay for goods and services in stable coins. I suspect that's the case. It's hard to prove because these people don't raise their hands and tell you that they're doing this stuff. The other area you see stablecoins growing really fast right now is in cross-border remittances. It's both B2B and B2C. There's a company focused on the US-Mexico corridor called Felix Pago, and I can't disclose their numbers, but I've seen them. But I can tell you just like spectacular growth rates, multi 100% year over year, and the business is crushing it. And they have a WhatsApp bot that you like text, send $50 to grandma or whatever, and it it sends money from your Bank of America account through a service called Bridge. Stripe just acquired Bridge for $1 billion onto a blockchain, sends the tokens over the blockchain, and then I don't know exactly how the conversion works to get pesos to grandma in Mexico, but they obviously are working out the backside. There's tons of remittance services now using this that are crypto native. I don't know if companies like Wise are doing this today or not Wells Fargo, Western Union. But like they're all thinking about it, and I suspect a lot of these guys are. If they haven't started, I bet you all of them will start this calendar year in ripping out their rails in the background and using stablecoin rails because it is faster and cheaper. They don't have to tell the world they're doing it. I just think that they probably will. And then on the B2B side, there's now tons of companies focused on cross-border B2B, again, remittances, and that's growing pretty fast.
In the past week, I had 4 chief product officers of fintech and payments companies say, "Hey, Simon, where do I get started with stablecoins?" So I think you're absolutely right that it's definitely coming.
Yeah.
But if you were to speak to some of those institutions, how do you answer that question? Like, "Hey, I'm from the TradFi world. I'm trying to understand this space." Like, do you get that question, and how would you answer it?
Most of the fintech guys don't call me. If you're an established fintech business, you just don't call a crypto hedge fund manager. It's just not Just not a thing that they do. I
It's a
wish they
thought
did.
experiment.
I'd love to talk to them. I'd answer the phone if they called, but sadly they don't. If you're listening to this and would like to call, my email address is Simon. You can put it in the show notes. It's Kyle@multicoin.capital.
Yeah.
But look, where would I tell them to start? Pretty straightforward. Go look at Bridge. It's straightforward API. You can plug it in. There's a bunch of companies that build even on top of Bridge now. Companies like Borderless Labs and others that leverage it for different flows. And like all of the APIs are there, and like start plugging them in. I am biased, and I would tell you use the Solana blockchain. It is the fastest. It is the cheapest. The other ones are objectively slower and more expensive. But otherwise, just go hit those APIs.
Yeah. How do you think about the kind of decision to use, like how to choose which blockchain to use from an institutional perspective, and where Solana is now compared to a year ago? It seemed like anecdotally, when you had banks and other large asset managers trying to come into the blockchain space for the first time, they'd start on Ethereum. Biddle was on Ethereum, and it was kind of like the lowest risk place to start. But then they're starting to recognize that Ethereum doesn't scale, and so then there's the question of do you keep the EVM stack that you're on, but then do you go to a layer 2, and if so, which layer 2, or do you take the leap and say, okay, we're going to go build on Solana, but there are fewer engineers inside some of these institutions that have experience with Solana programming in Rust. And so how do you think about like that institutional adoption of Solana and the competition between Ethereum and Solana? I feel like it's clear Solana has been winning on the retail side. I think the institutional side, it's still early, and it's a lot slower moving. Different considerations for large institutions to decide which blockchain they want to issue an asset on or start using for payments.
Yeah, so I think the human capital considerations are real, but I don't think they're the primary drivers. I think most folks who are trying to do anything using stablecoins on a chain, their number one priority is don't get fired. And the way you don't get fired is you go to the top vendors. Ethereum being a vendor of block space, so to speak, it's number 2 in market cap after Bitcoin. It's like, okay, cool. No one gets fired for choosing Ethereum, even though it has obvious technical problems. And I think that was the primary thing that drove most of the decision making. The other major thing that helped was Ethereum was officially deemed not a security, which obviously just like helped get through legal and compliance. That latter point is about to be reversed. As of either yesterday or the day before, there was a Solana ETF filing that the SEC did not reject. There's like a 7-day window, and they can reject it for whatever arbitrary reason. And the first Solana ETF ever got through past that 7-day window and was not arbitrarily rejected. And so all the people reading the tea leaves are like, hey, this means that the SEC's stance is that Sol is no longer security. That has not yet been officially mandated from the gods at the SEC, but I expect in the next month or two that will effectively become official. So that's about to go away and level the playing field. At this point, Solana obviously is number 2. It's number 3, but after Ethereum. But my guess is at this point, most folks are they look at Solana and Ethereum at least as okay, well, I need to seriously evaluate both. I think 12 months ago or 24 months ago, people were just like, I'm not even going to bother to evaluate anything other than Ethereum. And just given, the amount of press Solana receives, and the fact that, look, most of these executives, their kids are probably trading meme coins on Solana. That's my experience is that most folks in their 40s and 50s who were kind of being forced to get into crypto, for some professional reason, their first exposure is via their children.
But is that a feature or a bug for an institution? Just take that point of the kids are trading meme coins on Solana. As an institution, does that make you want to issue your assets in the same place that your kids are trading meme coins? And on one hand, it's distribution, and those are consumers. On the other hand, there's brand risk, and this is the chain that's using some weird brand that I don't really like. How do you think about that calculation?
Yeah. So people are right to ask the questions. I think if I were a fintech or banking executive thinking about this, what I would say is, hey, what can I observe about Ethereum, Arbitrum, Base, Solana in performance real world settings about how these systems are performing. And the beauty of the meme coins is that although they're like obviously silly, they are the best stress test you can imagine. The Trump meme coin drop a few weeks ago was the single largest trading event in the history of crypto capital markets, full stop. And it was on the Solana blockchain, and the network handled it. And there has never been anything like that before. And it's just like, okay, well, if I'm Visa, if I am NASDAQ, if I am BlackRock, if I'm Bank of America, and obviously all of these businesses run at scale, and you're like, okay, well, like, I don't know which one of these is actually going to work. Today, like, without question, the one that has demonstrated the most real world proof that it can work under load is Solana. That statement was objectively not true 24 months ago. You could say it was debatably true 12 months ago. But today, like, ask anyone in the space who's not trying to lie to you, and it's just like no one, everyone knows, like, the real world stress tests are happening on Solana. And so that to me is the most important vector to think about, because look, all of these, the history of crypto is systems get saturated, it's fee spike, becomes unusable, transactions get dropped. You know, like, this happened time and time again. Look, Solana, to be fair, probably went down. It's crashed like 7 or 8 times in its like 5-year history. It has actually now been more than 1 year since the network went down. It's like 367 or 368 days as of the current moment. Well, all of the Ethereum L2s, all of them have gone down in the last 12 months, without exception. Every single one of them has gone down. Amazon, AWS, Azure, and Google Cloud all have had outages in the last 12 months. So, like, at least over the last 12-month period, the Solana network has higher stability than any of the like other things you would kind of logically comp it to. And among its direct peers, meaning the L2s and Ethereum, the demand load is way higher. Not only Trump spike, weekend, but also every single day. Daily active addresses on Solana are every single day 5 to 10 times higher than Ethereum and all the L2s. Trading volumes every single day 2 to 7 times higher than Ethereum. And so both the sustained load and the spike load, like, we have enough empirical data that you can very objectively say, like, this is now the fastest horse.
I think there's a couple of points between the lines, isn't there? There's the ETF looks likely the regulatory environment has changed, so the risk calculus has changed from an institutional perspective, and then the risk calculus has changed because of the scalability and the performance kind of elements to it. And then the third aspect is the early days of the iPhone, it wasn't seen as a serious business machine. People were still preferring their BlackBerry. The early days of cloud, people didn't see it as serious. It was for these small startups. And that's kind of a common refrain. Same with the internet. There was a bank that tried to build its own internet once, quite famously. So there's definitely always that reaction. And maybe don't look at the meme coin, look at the data, I think is a great point. I'm going to have to pause us here just to very quickly thank our sponsors. This episode, if it isn't already obvious, is sponsored by our friends at Visa, the leader in digital payments. Visa's Tokenized Asset Platform, or VTAP, uses smart contracts and cryptography to help banks bring fiat currencies on-chain, whether it's launching a stablecoin or deposit tokens or something else. VTAP allows financial institutions to issue fiat-backed tokens, improving financial efficiency and enabling programmable finance. Check out the links in this episode's description to express your interest in VTAP. This podcast is sponsored by our friends at BVNK. And if you've been listening to this podcast, you've probably heard us say, every business needs a stablecoin strategy. And if you're looking for the best place to start, that's BVNK. BVNK is the leading provider of stablecoin payments infrastructure, helping businesses move money faster, settle globally, and even launch their own stablecoin products. All with licensing and compliance so you can build with confidence. We're proud to partner with BVNK on Tokenized. To learn more, visit bvnk.com. Thank you to our sponsors. Kyle, Before we close out today, I just want to talk about some trends for 2025 and beyond. Really, what you're looking at and what you're focusing at. A lot of people talking about tokenized real-world assets and treasuries and those sorts of markets. What are your thoughts on that space?
Yeah, so tons of people are getting in this now. BlackRock really has led the charge, and it's been awesome to obviously have the arguably the number one brand in the world as it pertains to tokenized funds getting there. I think they have roughly $1 billion of assets issued on various chains, approximately. And that number is obviously going to go vertical this year. Franklin Templeton, Citi, Fidelity all have announced tokenized products. They're in various stages of launching. I expect there's a bunch of crypto native startups that are also doing this stuff. Ondo, Superstate, again, there's like 20 or 30 more. So people are trying to use crypto rails to distribute, tokenized fund products to people all over the world. That for me as a big investor in Solana, I'm very happy about that. I will be an indirect beneficiary of that. I don't
Where do you
find
think the demand comes from there? Like who's in your mind, like who's buying those products today? And over the next 12 months, is it all crypto capital? Or, do you see like traditional institutions coming on chain to buy tokenized treasuries? Like what's the demand?
Yeah, no, the latter you described is zero. If you are today buying treasuries or Franklin Templeton's, whatever mutual funds, or like, you're just going to keep doing what you're already doing. The play here for all of the large asset managers or fund managers is put your fund products today on chain and then get them to retail people all over the world. I think the biggest challenge most of these fund managers have is they don't really know how to do the go-to-market. If you have a team of, whatever mutual fund, Franklin Templeton mutual fund, and you got a bunch of guys in New York who have made the fund, and you're like, great, we made the tokens on Ethereum, tokens on Solana. Well, like, yeah, but now you got to get it in the hands of people and educate them. And like, again, Americans can already buy that thing through their Schwab account or their Robinhood account or whatever they have. And so you need to get that thing in front of guy in LATAM, guy in India, guy in China. And obviously the team in New York is like, quite frankly, like the wrong team to do that. And so I think that the big thing that most of the Wall Street firms are going to struggle with is the go-to-market. And I think what they need to do is they need to be cultivating relationships with the various regional go-to-market teams. And there's like the global players. So like the Phantoms of the world. Phantom is the number one wallet for Solana. You should be trying to potentially, work with Phantom on something. And like Phantom, as of this moment, does not have a tab that says like tokenized funds or whatever. Maybe Phantom will add that tab. I don't know. But if I was Franklin Templeton or BlackRock, like that's what I would be pushing Phantom to do, to like showcase, my fund products. The other kind of obvious thing for those folks to do is to go to all of the regional players. And there's tons of regional wallets that like focus on Vietnam, focus on China, focus on Colombia, on Venezuela, and going to those teams and trying to distribute, through those guys. And obviously, I think those regional teams probably should generally be interested in doing so, both because like it's a way for them to sell yield to effectively their customers. Like it makes their product more attractive, and it gives them legitimacy. Where if you open one of our portfolio companies is called El Dorado. They focus in Colombia and Venezuela. And presumably it's going to give some brand legitimacy to El Dorado if there's like a BlackRock logo like somewhere in there, obviously with BlackRock's, blessing. And so it's a win-win for both parties. And so I'm optimistic it's going to happen. It's probably not going to happen as fast as I would otherwise want, but that would be my number one piece of advice to token funds.
It's fascinating. It's changing the distribution model that you would have traditionally had, and you were just thinking differently about it. The distribution of the US dollar for payments is now well understood. Stablecoins have become the killer app. The distribution of other asset classes from the world's largest capital market, the demand is equally solid. It's a helpful frame for, I think, for a lot of folks. Are there any other trends that are really catching your eye? You talked a little bit about decentralized compute. Is that something that orthodox businesses are going to be taking on? Is that going to be a net new market? Is that going to be bottoms up adoption from the global south? Like these seem like trends for you.
Yeah, so DePIN is a space we spend a lot of energy on, and there's a bunch of sectors of DePIN, but probably the one that is most relevant to your audience here is the GPU marketplaces. I'm assuming most folks listening to this are thinking about AI and thinking about inference and such. The basic insight here is that there's a lot of GPUs laying around the world that are not being put to use. For context, roughly 45% of all global data center spend is across the three hyperscalers, meaning Amazon, Google, and Microsoft. And that means 55% is not across those three. So those three have obviously 94% of the mind share, but only 45% of the spend. And all these long tail data centers all have excess capacity. And so there's a bunch of teams and two of our portfolio companies specifically. One is called io.net and the other one is Kuzco.xyz, Kuzco. And both of these teams are going to these long tail. There's roughly 3,000 or 4,000 data centers around the world. It's quite a few. And basically saying, look, you guys have excess GPUs, please make them available on our network. And then those GPUs can be spun up or down on like 3 seconds notice. And so to run AI inference workloads. Today, just between IO and Cusco alone, annualized revenue is north of 30 million. And that number will probably finish this calendar year north of 100 if I were to guess. And so fast growing, their value prop to customer, what they sell to their customers is tokens, like whether it's Llama or Mistral or whatever, but it's, or DeepSeek now, tokens per second. And you can obviously pick which geography you want if you have like some latency sensitivity to India versus the United States or something. And so perfect abstraction and is available globally, and it's way cheaper than the hyperscalers. So like that's happening globally, super cool. I'm guessing most fintech folks are at least thinking about stuff like this. That's a really cool opportunity. The other area I spend a lot of my time thinking about right now is, yield on chain. There's so much activity now in crypto native capital markets, between the meme coins, between the derivatives protocols, such as Drift, on Solana, and then among the borrow lend protocols. So things like Camino, again on Solana, that you can now park your USD on chain into these various vaults and such. And like the vault, your yield will fluctuate pretty wildly per day. It'll go as low as 7 or 8%, but like it will frequently spike up to 50% or higher. And you can earn incredible yield. I can tell you, I have all of my US dollar denominated net worth on the Solana blockchain earning very healthy yields. And I think the demand for capital to earn these yields is pretty high. Obviously, there's risks here. I don't want to in any way call this risk-free, or even SOFR, plus 200 bips. I would not think about this in those terms, but it is all fully collateralized, and you can earn incredible yields. And I think selling that to institutions and to retail investors around the world, that wave is gonna, the next 24 months, that's gonna keep on going.
Yeah, risk appetite may vary, but risk reward is there for the taking. That's a fascinating frame. Is there anything we didn't ask you that we should have done just before we close out?
I mean, the question people ask me these days is, when is Solana going to flip Ethereum? That's the number one question I get. I put it at 30 to 50% probability that it happens this calendar year. I put it at 90% probability it happens by the end of 26.
You heard it here first, guys. Well, listen, that puts us at time. Kyle, where can people find out more about you and Multicoin and your portcos?
Yeah, if you have any random questions, you can email me, kyle@multicoin.capital. And then I am very active on Twitter. I'm a very colorful character on Twitter. And my Twitter handle is just my name. It's @Kyle Samani. And then if you want to check out Multicoin, we have a very widely read blog. I think it's the best blog in crypto. I'm a very biased party. But if you go to multicoin.capital, there's a subscribe button, and we have hundreds of free stuff out there, research pieces. Can recommend. How about you, Cuy?
On X @Cuy Sheffield and visa.com/crypto.
You'll find me on Twitter @SyTaylor, SYTaylor, and you'll find me at sardine.ai or fintechbrainfood.com. Listeners, thank you so much for listening. Kyle, I really appreciate you being here, man. This was a great conversation, great to catch up. I think the audience is going to love it.